Good morning, good evening, good afternoon, good evening, everyone, and thank you for joining us for the second day of our virtual global seminar. Yesterday, we heard from members of the IAIS Executive Committee as part of our EXCO dialogue, in which we covered off progress with key aspects of our current roadmap and also discussed work on key strategic themes and looking ahead to the next 5 years under our new strategic plan. For those who missed it, the video is already available on our website. But today, we will do a deep dive into two topical elements of our roadmap. First, we will have a panel discussion on insurers' asset management in a changing interest rate environment. This will consider the implications of increasing investment in private assets, increasing use of cross-border asset-intensive reinsurance, and the implications for the risk profile of life insurers. Then secondly, we will have a panel session on the use of artificial intelligence in the insurance sector and looking at how supervisory tools can be used to address emerging risks from its deployment. During today's session, a QR code will be displayed. Please have your phones ready to scan the QR code so you can join some live polling on both panel sessions. So with those brief introductions, I'm now pleased to hand over to Charlotte Gerken, Vice Chair of IAIS Executive Committee and an Executive Director at the Bank of England, who will moderate our first panel. Thank you, Charlotte. Over to you.
Yeah, thanks very much indeed, Jonathan, for introducing our panel on insurers' asset management in a changing interest rate environment. A welcome to everybody and particularly warm welcome to a fantastic panel that Joe Perry on the IAIS has assembled. I would like to just ask each member of the panel to just briefly introduce themselves. The full biographies of all the panel members are on the IAIS website. So if I start with Stefan.
Thank you, Charlotte. Stefan Holzberger, Chief Ratings Officer at AM Best. Delighted to be here.
Thank you. Keisuke?
Good afternoon and good evening here in Asia. This is Keisuke Kawasaki from the Chief Investment Officer for Nippon Life. Honored to be joining you here.
Thanks, Tim. Tim, you're on mute. Apologies. Should have spotted that sooner.
Shouldn't be. You not hear me?
There we are.
Okay. Sorry. I said good morning, good afternoon, or good evening, depending on where you are. Thank you to the IAIS for having this event. A great meeting, and I'm happy to be here. I'm the Chief Investment Officer for Prudential Financial, the U.S. Prudential. I always have to say when I'm speaking to Europeans.
Thank you very much, Tim. And Julia.
Yes. Good morning, good afternoon, good evening also from my side. I'm the Chief Executive Director for Insurance and Pension Fund Supervision in Germany for the BaFin. So delighted to be here.
Great. Yeah, well, thanks. As you all see, a fantastic panel. So I just wanted to say a brief couple of words of what the IAIS has been doing sort of in this area. I'm very glad to say, though, that as well as the panel needing to work hard over the next sort of 55 minutes, we're going to be asking a few audience polls, questions with a polling. So please, do get ready to participate in our session today. On the IAIS side of things, one of the most kind of relevant sort of pieces of work or studies that we've been doing is around structural shifts in the life insurance sector. And our work really has been focused on two interlinked issues. The first issue being the impact of growing investments in alternative assets, as Jonathan outlined in his introduction, and the potential that those investments bring to increase exposure to liquidity, valuation, hidden leverage, and credit risks. And we've outlined some of our concerns in those areas in our global insurance market report, the annual report last year, which I would recommend. We discussed concerns around discretionary valuation, liquidity risks, that hidden leverage that I mentioned, and credit risk, plus transactions with affiliated parties. The second issue is the trend of cross-border asset-intensive reinsurance, whereby a material part of an insurer's investment risk is also transferred to reinsurers. Cross-border asset-intensive reinsurance has raised supervisory concerns about knowledge gaps in non-domestic prudential frameworks, limited information exchange, and concerns regarding conflicts of interest within corporate structures. Financial stability risks encompass concentration risks at the jurisdictional and reinsurer level, as well as potential herd behaviour amongst insurers. So the IAIS, we're going to continue our monitoring and assessment of those potential financial stability risks, and we'll keep everyone updated through the outcomes in this year's annual report as well. So quite a lot going on around insurers in investments, and that has certainly generated a lot of interest in our panel today. So I was going to pull up, I think if that's possible with the help of the Secretariat, a first kind of question we've got for everybody, and then while the answers are coming through from that, we can hear panel's views, and then we'll compare that with yours. So if I could have the, if I can find the right way to do this, apologies. Could I have some help, please, from the Secretariat to work this small slide?
Yep, the Slido is now showing.
Thank you very much, Joe. Many apologies. The ability to put that up has disappeared for me. So that question, the first polling question is, what impact will the changes and volatility in the current interest rate environment have on insurers' asset allocation over the coming 18 months? And just one answer, please, between 1, very significant impact, 2, significant impact, 3, moderate impact, and 4, minimal impact. So I hope that poll is now open. I'm happy to be correct, Joe, if I also need to do anything further with that for now. But can I then turn to the panel? And the first question, I think, Stefan, a question for you first. How do you expect changes in the interest rate environment, and including a theme for higher for longer, which still seems quite a bit strange to say, but how do you expect those changes to impact life insurance assets and allocation decisions over the next year?
Sure, thank you, Charlotte, and thanks to Jonathan and Joe and to the organizers at the IAIS for giving me the opportunity to join the panel. I think it's a very appropriate topic. It's something certainly on our mind at AM Best, and maybe I'll start with my comments to take a step back and look across the life and annuity sector from a rating standpoint. And on that front, we see a great level of stability in terms of our rating activity. If you look over the last couple of years, certainly since COVID, we've seen a general progression of more stable affirmations with regard to the rating actions, in contrast to perhaps prior years where we saw more negative rating activity. So I would say that overall, the life and annuity segment, from a rating standpoint, is really showing good level of stability. And I think the reason for that is that life and annuity insurers have been beneficiaries of the current improved rate environment. And if you couple that with the demographic trends, baby boomers in the United States, older generations where the wealth tends to reside looking for retirement and fixed income products, it's been an extremely favorable environment for the segment overall. And we're seeing that in earnings, we're seeing that in capital growth and new business revenues. We've seen a manageable level of surrenders for the segment and really no signs of disintermediations. In the United States, for example, the banks continue to sit on the sidelines. So the insurance policies for life and retirement tend to be the best opportunities for these folks looking for savings and retirement products. I would say if you look at the United States, for example, individual annuities have surged over the last 3 years, record growth year over year. And when we talk about, and I know we're going to really get into the detail of what's happening in the investment portfolios, but that really is a reaction to what we're seeing on the product side, right? As more spread-based products come into the portfolios, the product portfolios of insurance companies, their asset allocations need to change. So what are we seeing? We're seeing increased allocations to alternative assets as well as private bonds in an effort to improve and maximize that spread. And really, overall, we expect that to continue.
As well on the overall market. Thanks. Now, Tim, Stefan just sort of mentioned there some of the impact of spreads and where that's taking, the impact of that on customers and insurers. How do you see the credit environment, particularly spreads, affecting insurer asset allocation, particularly for those assets backing asset-intensive products? And are there any other trends you expect to affect asset management for insurers? Tim, you're on mute now. We're all as bad as one another. Tim.
Hi, can you hear me?
Yes.
Oh, okay. So I was just going to start off by saying, generally speaking, I think there's been two surprises to most participants in the market over the last year. The first being that rates have stayed high for longer. As you mentioned, the higher for longer, the high forever language. I think that's really just a reflection of how sticky inflation was and how hard central banks have had to work to try to get inflation down to their longer term targets or even close in the zip code of their longer term targets. So that's been a bit of a surprise to the market. And as Stefan said, that higher rates have generally been good for insurance companies. I think we'll talk about that a little bit later. The second surprise, at least in the US, I think, has been the resiliency of the economic environment in an environment of high rates. You've seen only recently some relief or some stress a little bit showing up in the employment numbers. And maybe you're going to see a little bit of a pivot on the Fed's part to talk more comfortably about rate cuts. But the overall resiliency of the credit markets and corporate earnings, I think, has been really the second surprise in the context of these higher rates. So spreads, as you mentioned, in generally are tight. They've come off of their recent tights, but in general, our view would be that spreads are pricing in a soft landing. Some people might go so far as to say that spreads are pricing in perfection in the credit markets. I'm not sure that that's quite true, but they definitely are pricing in a good economic outlook and no immediate near-term recession of any kind. So there are still pockets within investments and the investment markets where spreads are attractive, and I think you have to be incredibly selective as we are trying to be as well. At Pru, and I'm sure this is true for most other insurance companies, the asset attractiveness or the attractiveness of credit assets in the marketplace is really looked at through multiple lenses. I can't think of an investment role that's more complex than insurance. And maybe even more so for public insurance companies. You've got statutory lenses, you've got accounting or GAAP lenses, you've got tax lenses, you've got competing priorities and competing constraints and sensitivities to deal with. So obviously we all look at the attractiveness through these multiple lenses. As an investor, you'd like to look at it as a spread on economic risk. And I think regulatory capital regimes and rating agency regimes are designed or intended to try to capture the economic risk of the underlying assets. No system is perfect, but you have to look at those through those lenses as well. And as I said, I think the assessment of value that insurance companies are making in their investment activities is completely consistent and in the context of their own economic outlook. If you're viewing a soft landing or a relatively benign economic environment, I think you're going to see people pursuing and buying credit spread assets at these spread levels, even though they are at historically tight levels, because you're basically going to get the carry of those investments, not much more in the way of total rate of return from spread compression, and people are going to be comfortable with that. If you're concerned about recession risk, I think you're going to look at these spread levels and think they're too tight in many markets. At Prudential, we're watchful as rates have stayed high for longer, particularly in areas of the credit market that finance themselves with short-term rates that are being hit the hardest from high short-term rates, even though spreads are relatively tight. All-in yields and borrowing costs for these types of credits are pretty high, and so that would include most floating rate below investment grade issuance. Direct lending is a big market and a growing market. I think those are companies that finance themselves with short term, and you're going to see margin compression in that area. And then obviously in private equity portfolios, the portfolio companies generally finance themselves with short term rates, and that's affecting some valuations and some liquidity constraints there as well. Just in terms of trends in the market that I think we'll see for insurance companies, you are going to see a continuation of the growth of private credit in general, or ABF, or structured private assets. There's lots of names for what you're seeing here, but you're seeing a massive amount of debt flowing out of banks and banking system into other sectors, and insurance companies are participating in that just as much as anybody else. And I think that trend will continue. The Fed has gone on record in the U.S. as saying they're not worried about that. The concerned about a shadow banking market developing. They don't seem to be concerned about that. So I think that trend will definitely continue. I think when you look at the higher rated tranches in those types of structures, I think spreads look very attractive for investors. It's hard to stress those where you see significant losses or any losses, frankly, at the more senior tranches. At the lower levels, I think you have to be very, very careful. I think in stress environments, you will see some significant downgrades by the rating agencies or actual losses, and I think you have to be very selective in those instances. And then just finally, for insurance companies, spreads are what we look at as compensation for risk, and you have to feel. I know my team feels that we have to be compensated for the risk, but yields fund liabilities, and in that sense, as Stefan said, that insurance companies like higher yields. That's been good for insurance companies. It makes products cheaper for our customers and clients, and particularly for longer duration liabilities that assumptions were made about long-term rates for tail cash flows. This is a pretty good environment to hedge that out, essentially, I think. And I think that's going to be a good lift for insurance companies as well. Thanks.
Thanks very much, Tim. And well, it's just as well that you do want to perhaps kind of go into the private credit side of things more, because we're certainly going to do that later on in this session as an important area. But I know particularly your remarks about kind of selective, whether it's the kind of public traded debt or indeed the private sort of credit side of things. I think about kind of rates and very different sort of kind of rate environment by sort of kind of in history terms, at least. But Keisuke, on the change, how are the changes in the interest rate environment and investment yield affecting insurers in Japan? So the rates have been quite a kind of different history.
All right, thank you, Charlotte. Well, I see a new landscape for Japanese life insurers right here. I guess in Japan, interest rate has been on a declining trend for over 30 years. And at the moment, I guess we haven't seen any interest rate rise as we see today. I guess in my view, Japanese life insurers are facing two first-time experiences. The first one is the relationship between the average assumed interest rate and the interest rate itself. In Japan, over 30 years ago, insurance products were sold with assumed interest rate around 6%. Declining interest rate led to a situation to negative spread. And to overcome such situations, Japanese life insurers expanded their investments to more riskier assets such as foreign bonds and a topic here, private assets, alternative assets. And but now I guess interest rates have been rising, and the interest rates on the 30-year JGB has exceeded the average assumed interest rate right now. And this environment makes investing in ultra long JGB attractive for managing liabilities. And Japanese life insurers are finding value in yen investments. The second is, again, 30 years ago, asset liability management, ALM, practices were not well established and asset durations were extremely short. Now, I guess, however, many life insurers have extended their asset durations and preparation for the introduction of economic value-based regulations. And for the first time, life insurers are entering a rising interest rate environment with ultra long-term assets. However, I guess in this rising interest rate environment, it creates a challenge of unrealized losses expansion on the asset side. For example, for Nippon Life, domestic bonds had an unrealized loss of around 1 trillion yen as the fiscal year ended March 31st, 2024. Since these long duration assets are the results of matching strategy with the long duration of liability, this doesn't impact solvency, but the unrealized losses in accounting terms could lead to a reputation risk. As a result, there may be a move to limit yen bond investments. Each Japanese life insurance company is in a different situation, I guess, right now, led by its corporate strategy. As in the past, I guess we all look like the same altogether. Some companies already have asset duration exceeding their liabilities, while others may process of lengthening their asset duration at the moment. And some companies may look into heavily on foreign currency dominated insurances because of the rising foreign interest rates and weaker yen. Having said that, I guess it's not a straightforward decision that interest rate increases will significantly expand yen bond investments. Although it is also a difficult decision for the investment side, that the rise in interest rates have made positive aspects for insurance company as a whole. As Stefan has said, a certain level of interest rate allows us for more diversified product designing, and that's very good for us. To this extent, I believe whether in an investment strategy or product strategy, these differences among companies will become more pronounced, and I think this will be a new era for Japanese life insurance companies. Thank you very much.
Thank you. Good to have that kind of view. We'll soon be able to compare views from our panelists so far with the participants. But first, I just wanted to ask Julia, if with these macroeconomic trends, what issues do you think supervisors need to focus on?
Yes, thank you, Charlotte. So first of all, as all the others said, I mean, this rising interest rates is good news for the insurance industry. I mean, capital investment is less challenging, and the trend of recent years towards, let's say, rather risky investments has slowed down a little bit. And the guarantees, especially in life insurance, can be earned with less risk, and capital requirements are, let's say, no constraint anymore, as it has been in the past. So this all is good news, and but obviously this positive effect always, and this time as well, comes along with a downside, and this is the potentially increased liquidity risk. So in the past, liquidity risk has been, let's say, immaterial risk for insurers, and now it has slipped into the focus of consideration for insurers as well as supervisors. And so liquidity risk, from my point of view, has two facets. So let's say 1 or 2 years ago, we all feared that there were higher cancellations and reduced new business, and the policyholders would behave, let's say, financially rational. But to be honest, we haven't seen this, so not so far at least. And I don't know where the threshold is, to which extent the interest rates should rise until the policyholders will behave financially rational, but we'll observe that in the next years. And on the other hand, it is the expenses of liquidity. So due to the increasingly illiquid asset allocation that we have in the balance sheet of the insurers and the hidden losses, liquidity really has a price, and that must be processed in the local financial statements. So this is why liquidity management and liquidity risk have been monitored closely since last year by the supervisors. And I also think that also the insurance companies, they had to improve their asset liability management in the past 2 years, and they learned a lot in the last 2 years. Maybe except of the Japanese ones, because they had a really special situation in the past. So, but it's not only the rise in interest rates that has had an impact. It is also the rise in inflation, which has also been substantial, and with an effect on the profitability of some products, especially car insurance and so on. They suffered significantly. It resulted in a need of increasing reservations, profitability, and pricing. So there as well, we see some resulting risks which are on our supervisory monitor. And then when I look at the investments, so all the risks that are in the investments of the insurers, you know, there have been some worrying developments when we look at the real estate market, especially commercial real estate in particular. So overall, I think there's a less challenging investment environment, but it is challenging in terms of risks in the asset allocation, and that has to be monitored very, very closely by the supervisors. Thank you.
Thanks very much for your perspective. Now I'm just going to ask Joe if he would share the results of the participants' poll, which I'm also hoping to be able to kind of see, but I'm going to have to rely, I think, on Joe's telling me what the answers are, with over half of our participants at 54% saying significant impacts on insurers' asset allocation from changes in volatility in current interest rate environment, and 33% saying a moderate impact. So some, differing kind of views there. What's kind of underneath that might be coming through from some of the kind of different, well, very different markets that we have and geographies as well. Didn't ask whether it was going to be a significant positive impact or not, but that seemed to be generally the view of the panel. So there's nobody can. I'd suggest we do kind of have to move on because this is already been a lot discussed and a lot more to do. But so a little bit more work actually on the part of participants, I'm afraid now, with a second poll as we move on to strategic drivers for changes in the life insurance sector, some of which we have already been touching on. And the question is, which hopefully you'll see on your screen just now, is what implications does the increased use of asset intensive reinsurance and allocation to alternative assets have for the risk profile of life insurers? And again, one is significant increase through to actually 5 significant decrease for risk profile of life insurers. So on those strategic drivers, and I think we'll just have to take a couple of contributions from our panel. I want to sort of ask you, Stefan, how credit rating agencies view the increase in the allocation of life insurers to alternative assets and the growing use of asset-intensive reinsurance transactions.
Sure. So when we speak with our clients, many emphasize that their alternative assets are kind of lower risk comparatively. I think, as Tim mentioned, they're investing in the senior tranches where they have the embedded protections from the lower tranches. They're highly rated and they're well diversified. So, of course, at the rating agencies, we tend to trust but verify. So when we hear that the alternative assets are lower risk, we really engage in a fairly in-depth conversation to really get into the risk and as Yulia mentioned, the liquidity that's inherent or lack of liquidity in that portfolio. But really overall, the trend towards greater allocations to alternatives for AM Best means that our analysts need to dig deeper into the asset portfolio and really get in there and assess the risk. We have dedicated resources to support our analysts to do a deep dive, not only into the investment portfolio, but to assess liquidity as well as ALM. And kind of the broad framework around enterprise risk management is also incredibly important in the context of that evaluation. So we'll leverage our investment working groups, our actuarial working groups to support the analysts to better understand the risks that are inherent in the portfolio and essentially examine how effectively liabilities are matched. Again, kind of that point being, you really can't just look at the asset portfolio in a vacuum. You've got to look at it in the context of the products, of ALM, and of overall enterprise risk management. On the reinsurance side, kind of on our watch list, one of the things we are seeing is an increased use of either low-rated or unrated reinsurer counterparties, as well as cessions going to offshore reinsurers. And here, it comes back to those assets backing the ceded premiums. How are they performing? Are they good quality? Are they liquid assets? Also, with regard to different offshore domiciles, where you might have a comparatively weaker regulatory regime in that domicile, that's certainly a concern. There we have to really evaluate what are the capital requirements in that domicile, what's the level of engagement by the regulator, how actively are they surveilling the companies in their, under their jurisdiction. So that is a trend that's kind of on our watch list. Overall, the insurance companies, I would say, are making very prudent decisions in terms of their asset portfolio, as well as who they choose as their reinsurance counterparties. But of course, there are always exceptions to that rule. And in those exceptions are where we really need to dig in and assess the risk more thoroughly.
Thanks very much, Stefan. And Tim, I gave a bit of a view from the IAIS in my intro about what our annual report and our global monitoring exercise had identified. So from this kind of regulation supervisory side of things, and how do regulatory capital and reserving requirements inform your asset and liability management practices, particularly thinking about asset intensive products? Tim, you're on mute.
Yeah. I've been unmuted. Thank you. Let me just say a few things about that. First, most private assets used by insurance companies are not new. And when I started in the insurance industry managing insurance portfolios, this was back in the mid 80s, insurance companies largely held what would be considered alternatives, in the sense that anything other than public bonds or public equity would be considered alternatives. And the portfolios were largely private credit, real estate equity for most of the mutuals, real estate mortgages. And it was really in the 80s when really disciplined ALM started to develop in the US construct with the regulatory environment. And I can tell you, I couldn't agree with a number of the things that Stefan said more. It's all about understanding the liabilities, understanding the liquidity needs of those liabilities, disciplined ALM. It's hard to sweep everything into one bucket as whether it's good or bad. It has to be taken in the context of the liabilities and the discipline and management around that. So I would say, in general, insurance companies have played in this alternative investment area, if you're talking about privates, for decades upon decades. And they're not new. They are less liquid, but not illiquid necessarily. And I think we have to make a distinction between, less liquid and illiquid. There's been a lot of secondary market development in private assets that has facilitated liquidity in those areas. Valuations is another issue that we have to focus on, is how do you value those private assets? And I think there, again, it depends on the rigor and the discipline that the investors have in terms of how they value those. There's no question that it's harder to value a private asset than it is to pull a screenshot off of Bloomberg and have a very good market value. But that doesn't mean they can't be valued. And again, given the nature of the liabilities that we have, the relatively illiquid nature of most of those liabilities, you can have a significant amount of your portfolio in illiquid assets and still have very good ALM discipline, and at the same time get protections and things that exist in the private market that don't exist in the public market, that enhance the credit quality of the overall portfolio through cycles, and also provide yield enhancement that makes products cheaper for our clients and our customers, which is good for not only the industry but society in general. They are more complex, and I think regulators need to be aware of that. And they're not all created equal. They are more complex assets, and you need to be sure that you have the capability to underwrite those complex assets. And a lot of it comes down to stress testing as well. You need to understand how those assets will perform through various cycles. So, to effectively manage these risks, I think you need to focus on liquidity, valuation, and complexity. You have to look at what insurance companies are doing to manage how they manage those risks. Like Prudential, for instance, we have extensive liquidity stress testing at portfolio levels, at legal entity levels, at the company level, different economic environments. We look at what in the portfolio could be liquidated over X period of time and how that compares with how our liabilities could become liquid over horizon. You have to look at those two pieces together. We also have thorough oversight from our risk organization of our credit underwriters in terms of what their rating methodology is and how that compares to the public market rating methodologies, as well as how those assets have performed historically through cycles. We have decades of experience in watching how our private credit portfolio has performed through cycles with defaults and recoveries and losses. And we know that those, for us, have been significantly better, stronger assets than what you could get in comparably rated publics. And I think that needs to be considered. I also think with regard to the complexity, you have to be sure you have deep credit and structure underwriting capabilities. It's really important to understand the structures of these complicated instruments, especially when you're talking about the structured finance ABF that's coming out. You have to understand the waterfall of cash flows. You have to understand what the risk cushions are below your tranche, and what scenarios will those cushions not be sufficient. And you have to understand that as well. So, we rely on our internal asset manager, PGIM, for that. But if you used a third-party asset manager, you would want to due diligence that very, very thoroughly. But I do think these are issues that are worthy of focus on the part of the regulators. But it needs to be done in a very specific manner with regard to how insurance companies manage those risks. So there are more tools than just capital charges. There are liquidity stress tests, playbooks for liquidity generation, things like that I think have to be all part of what's in the toolbox.
Thanks very much, Tim. That does kind of bring in kind of nicely not only the capital and reserving requirements but risk management as well. I think I'll turn to Julia then around the supervisory considerations here. Julia, what considerations do you think there are for supervisors given those issues, and how might there be kind of greater alignment between supervisors when dealing with kind of really global trends?
First of all, let me say I couldn't agree more on that what Tim said. I mean, risk management is key. Well, when investing in this alternative assets, I mean, the challenge is not so far for big insurance companies, but more for the smaller ones who also had this trend towards this more alternative assets, more risky assets, and so to make sure that their risk management is accordingly is a real challenge. So that's my point of view. Secondly, I would like to focus on this reinsurance topic. From a local perspective, in Germany, there are various reinsurers that have come forward with new and ambitious concepts in the recent years. But amazingly, they haven't reached market maturity or the corresponding demand. And the reasons for that are, on the one hand, so far fundamental reluctance, which is still there in Germany towards such concepts compared to other run-off concepts, and also the compatibility with the national regulatory requirements for life insurers, which are quite complicated. And then when I'm looking all around Europe, it is kind of a similar picture. There are countries where we see we see more interest in this kind of reinsurance than in Germany, but still there is a kind of reluctance. While globally, this topic is really becoming relevant. We see a real trend towards that. We see that reinsurers are pushing into the market with alternative ideas, especially in the US and also in Asia. And this is really becoming more relevant. So speaking for Europe, we are still skeptical because we see there are some significant risks associated with that kind of reinsurance, such as the credit risk, which is difficult to assess, obviously, due to the reinsurers' special business models, and also the link to the private equity associated insurance groups. There is the existing correlations with credit cycle shocks and the interaction between the asset portfolio and the reinsurance in the event of shocks. And at the end, it's clear the risk is not gone. The risk is only transferred. It is transferred to the reinsurers, and we see a potential accumulation risk going hand in hand with this trend on the balance sheet of the reinsurers. So we recognize that there is a global trend towards more asset-intensive reinsurance, more ambitious, more innovative concepts, and we are monitoring the development in Europe as well. And if we would see further demand and increasing push from the industry, of course, we would dive further into the analysis. So a little bit reluctant, let's say.
Thanks very much. Right, I think if we can put up the what our participants today sort of think, and Keisuke, sorry to put you on the spot, but what's your reflections on the poll responses?
Charlotte, I can't see the poll
Can you
response
see?
right now.
Oh, right, okay. Joe, could you help, as I've again lost the ability to drive here?
Yeah, of course.
Okay.
The
Thank you. Many
increase is
apologies.
53% and significant increase is 31%.
I see. I guess, regarding for the risk, I think I totally share the view of, what Stefan and Julia and Tim has said. I surely believe that we are on a kind of point, whether we are related to a reinsurance or not. I think all of the insurers need to be more aware about investment and also risk management, especially for, I guess, for liquidity. And the key would be, as Tim has raised, I think, what is the definition of liquidity? And I guess, what is a liquid asset? When do you need the liquidity? I guess every company needs to think about from their liability and towards their, investment. And I totally agree about what the poll has said.
Right, thank you. Thanks very much. Now we're going to have to move quickly on our kind of next round, which is really about the private markets growth. And some of this we have already really kind of, I suppose, touched on. But we've got another poll and asking participants what trends will there be in the holding of private assets by insurers in the next 5 years. And again, from one significant increase to 5 significant reduction. I think from our panel, I think I can guess which way they would be voting here. But we'll see whether there's any surprises from everybody listening in. And Keisuke, while you've kind of really got the mic, can I ask you first here, and I think, keep a brief answer as to what trends, perhaps that you haven't mentioned already, that you've observed in insurance investment in private markets and the considerations you make when investing in private assets.
I guess, what Tim has just said, private assets, alternative assets has been a kind of tool for Japanese life insurance companies to achieve higher returns from the past, I guess. And I guess to that extent, basically we have been investing to foreign private assets because of the lack of opportunities here in Japan. To that extent, I guess we have been heavily using outside managers. So I guess the due diligence for finding good investment manager has been the key for us to invest in alternative assets. I guess I want to raise one more point. It's regarding for responsible investments. I guess we, as today, we all are in a kind of era to achieve a net zero society here, and further a kind of expansion in transition finance is more and more required. And to achieve this goal, I think financing through private markets is mostly important. And I guess this is a key asset class that, how we can achieve that kind of goal. Thank you.
Thank you very much. And Stefan, you talked a bit earlier about the in what credit rating agencies are doing here, but with your own kind of credit risk assessment of insurers, was there anything else you wanted to add in relation to their investment in private assets?
Sure, I can make a couple of quick points. Hopefully my audio is coming across okay.
Yeah.
So private assets are absolutely trending up. If you take the US, for example, in 2018, private bonds made up 24% of invested assets. At year-end 2023, they had increased to 30%. So quite a substantial increase over that period of time. As a relation to capital and surplus, that's also grown significantly. And coupling that with the percentage of kind of higher risk assets also trending up, that does certainly have implications to the overall risk assessment. In terms of our risk assessment, the financial strength ratings, as my fellow panelists have mentioned, it really does come down to the quality of assets and the ability to thoroughly understand the complexities and the risks associated with those assets. Are they highly rated? Are they diversified? Are they performing? And are liquidity needs met? One point I would raise is that we've been in a benign part of the credit cycle for a long time. So whereas most life insurance investments are performing well, one of the questions that we ask is, have they truly been tested? Probably not. So most of our rated companies, they do take a prudent approach in terms of the riskiness of their investment portfolio, but there are some outliers. When we look across the different ownership structures, tends to be the asset manager or private equity owned life insurers have the greatest risk, have the greatest allocation to alternatives, employ the greatest amount of leverage. So as a group, that's one that we're spending a little bit of extra time doing that sort of risk assessment in support of the financial strength ratings. Thank you.
Thanks very much indeed, Stefan. And just finally, with Julia, you mentioned earlier about kind of liquidity risk being something that supervisors are very focused on, and the importance of risk management. Was there any other points you wanted to bring out as to the risks that supervisors are really focused on as insurers increasingly hold private assets?
I mean, these are the main risks that they should focus on: liquidity risk, risk management, especially. Those are very, very important. I mean, it is really I just can agree with all that Stefan said. I mean, the assessment really of the credit risk of the individual investments, the diversification, the correlation with the rest of the portfolio, the assessment of the collateral, and also the valuation of all these investments. This are a lot of risks where good knowledge is required. And that's why, to me, it's so important that really the insurers make sure that they only invest in assets that they really understand and they are able to manage with the staff and the resources that they have. So this is important. And we also require that the insurers really understand the business models of the companies where they invest in. We expect them not to blindly rely on the information which is provided by their asset managers. So they should challenge that. They should build up really the expertise in their own company. So a lot to do.
Yeah, thank you very much. So you can see let's see the results of our third poll, if that's okay with you, Joe, to put up those results. But I think the results are a 56% increase, 30% stable, actually. I think, although Joe, please correct me if that's got two amounts of stable written in my briefing.
Yep.
I'm afraid I cannot see this slide.
27% remain stable and 17% significant increase.
Right, thank you very much. So yeah, a very large proportion of you in the increase or significant increase side of things. Now, thanks to the efficiency of our panel, we have even got time, unless Jonathan tells me otherwise, for maybe an audience question. And I did have one in advance from Samuel Montero, which was how should insurance companies adapt their asset and liability management in the short term? I might just take the moderator's prerogative of just changing that question slightly. So should they adapt? I think given the panel talking about insurers needing to have good risk management, what do panel members sort of think of insurers' capability to adapt their asset and liability management, and are we seeing really those changes in risk management capability as insurers increase their interest in alternative or private assets? So who should I turn to first? Tim.
Okay, so thanks. It's a great question, and I think I agree with the change you made in the question. Fundamentally, I don't think that the growth in private credit, private assets, alternatives should change disciplined ALM. That's the framework that should survive, in my opinion. And I think that's how Prudential would approach it. The question, though, is do these new asset classes offer significant opportunities to fit within that framework to enhance returns, enhance pricing, and enhance the benefits to customers? And I think they do. I think they're, I look at it as added diversification of asset type and underwriting capabilities and other benefits, including in higher yield. So you're getting a lot of benefits into your ALM framework. We still emphasize broad diversification, solid credit underwriting, and interest rate risk management in our philosophy. All of these new asset classes that are coming into the space can fit within that. So in my opinion, disciplined ALMs should survive. It's how you prudently deploy these types of assets into that. And I just wanted to make one other comment I didn't get a chance to touch on earlier. Private equity is another category of alternatives, and it's the one that people used to think about when you heard alternatives before all of these new private credit. I think there is a very important a place in portfolios, particularly with long duration liabilities, for those private assets, private equity. You cannot match the interest rate risk in the tail cash flows beyond 30 or 40 years. There's a ton of data that supports the notion that those asset classes have generated returns in excess of 30-year fixed rate returns. And so as you see those cash flows migrate into the investable space, if your ALM strategy prudently moves that exposure into fixed income, I think those are excellent sources of ALM against the tail opportunities. And I think one of the things I think regulators should focus on is, do we have the appropriate regulatory framework for those assets in those types of portfolios?
Thank you very much, Tim. Unless there's, I think, any other panel members determined to have the last word, then I think we can kind of move to sort of conclude our session. But thank you. Well, thank you all very much, participants who've dialed in for taking part in the polls that we've run. And obviously a massive thanks to our panelists as well, kind of a virtual at least round of applause to you for really kind of giving us there's a kind of a mix of the fundamentals, as Tim just said, in asset liability and good risk management, stress testing. But also, I think some of the new sort of topics here for insurers and those who advise insurers to really think about in terms of the nature of some of the assets that insurers are investing in, and making sure that those are kind of well understood from both an ALM or rate yield perspective, but the underlying credit fundamentals as well. So a very big thank you to the panel, and thank you very much to the IAIS for organising this session today.